Hello, everyone, and all the viewers to this O&M webcast. And thank you for having me and for inviting me on. This is a very challenging time for a lot of investors. We've seen a significant crash and entering a bear market for the first time in many, many years. For many investors, it's a very difficult time. A bear market. A lot of stocks are down some 50%. For people that have been following gold stock trades and have been following the precious metals, many investors that have studied asset bubbles, the madness and the confusion of crowds, knows that over the past decade, we've seen a huge rise in the equity markets after the 2008 credit crisis. We've seen a huge asset inflation from 2009 from the bottom until recently. Up until even 6 months ago, I highlighted to my readers and my subscribers and the people that follow me on social media that we were in a bubble. There were many things that headlines that showed from mainstream media that they couldn't predict anything that could pop this bubble. All the mom and pop investors were getting over levered and using margin to invest in levered S&P products. And what we also noticed was that there was a lot of insider selling from these bigger tech names such as Jeff Bezos and Mark Zuckerberg and Bill, and we saw lots of CEOs that were resigning at the top. So there was lots of signs that there was a bubble. And then we saw at the end of last year, the Fed that was supposed to be raising rates started to lower rates. This was before the coronavirus. And we saw them get involved with the repo market, and we started seeing the yield invert. So there was lots of signs before this coronavirus that this asset bubble was having difficulties to maintain those levels. And now we've seen with this coronavirus and with this huge shutdown of the economy, this has just accelerated that decline. And we've seen now the Fed take unprecedented actions, lower the rates back down to zero, started unlimited QE, and announced this record stimulus, putting money, sending out money to all the American people, like we saw 2000 under Bush and after the tech bubble bursting. But we see that we had the tech bubble burst in 2000. We had the U.S. housing bust in 2008. And so once every 10, and then we had a long time, 10 years of a record bull market. And one of the charts that we sent out is the broadening top bearish megaphone pattern that we sent out back in, I guess, June or summer of 2019. So, you can't pick a top, but, we were maybe 6 months or 7 months ahead of the game. There was a broadening top bearish megaphone pattern that was developing, and very small group of stocks that were leading the way to new highs for the indices that really should have been a warning sign for people to at least get off margin and at least get some be more defensive. And since last summer, we also noticed that gold, which was basing for many years, 7 years, was beginning to break out of that multi-year base. And we saw this last summer, and we've been highlighting this breakout in gold that we saw last summer. We begin to see some of the miners before this coronavirus pick up, yet the move into the miners has not really happened yet. This has come to dismay of many precious metals investors, but it is good for people that may have had exposure to stocks and maybe need to change quickly to get some exposure to gold now and go defensive. There's still time. If you're looking for value in gold, it's very hard to find physical gold right now. The premiums between the physical and the paper are completely divergent, but the way to get discounted gold right now still is in the miners, and especially in the explorers and the developers, which are even further discounted, and the junior explorers are the most discounted and trading at levels not seen, still at gold price at $300-400 an ounce. So there's still time for investors to build a portfolio of some top-notch explorers and developers. And there's been a huge amount of money that's been moving from the last, I would say, 6 months since that June when I started sending out these charts with gold breaking out and the stocks beginning to top, long before this coronavirus even anyone knew about this. And now we're seeing months later, we're seeing inflows of money going from treasuries and stocks into gold ETFs. And we're seeing money being pulled out of the treasury market, the stock market. And finally, we're seeing money pouring into gold, which we haven't seen in many, many years. So this might not be the greatest time for the stock market, but it may be a great time for precious metal. We may be setting up for something that we haven't seen in maybe 40 years, where gold stocks soared and the S&P was flat or declining, like we saw in the 70s, or in the early 2000s after the dot-com. We saw gold move, the gold mining index move, whereas S&P 500 stayed flat. We saw that in the 70s. We saw that in the after the dot-com bubble. We saw that for a little bit after the 2008, from 2009 to 2011, we had a big run up in the gold stocks. And then, if we study the Great Depression, the 1930s, the gold stocks soared, like Homestake Mining, soared in value versus the Dow. And we're beginning to see this Dow gold ratio, which I talked about, eventually going to 2-to-1 or even 1-to-1. People thought it was crazy 6 months ago when I was talking about it, but now we're getting closer and closer to that. What's interesting, we're seeing record high gold prices, and we're seeing record low, 20-year low oil prices. So the gold to oil ratio is at an all-time high. What's that mean is that the miners are going to be generating, once these mines are up and running again after this coronavirus shutdown. And we're beginning to see that China peaked out, Italy may be peaking out, and the rest of the world may start peaking out in the next 2 to 3, 4 weeks. So it's not going to be forever. The mines are going to start up again, but they're going to have a huge gold to oil ratio. Oil's energy, diesel, these things are big costs in mines. This is going to get to the bottom line and generate free cash flow. Hopefully the miners will use that cash flow to invest in resource growth and discoveries, high grade discoveries, which we're focused on. So the gold to oil ratio has skyrocketed, and we're dealing with huge, massive unemployment numbers from this coronavirus. One area where it's going to have an impact, on real estate, the commercial mortgage market, commercial properties might be in danger. The real estate market is still very overvalued. The stock market's still overvalued. I don't think that this is going to be so quick. I think there's been issues, systemic issues before coronavirus, and this is just going to exacerbate the unlimited QE, the zero negative interest rates, and the stimulus and the deficits. Just going to exacerbate a gold market that was already breaking out, and a cycle that was already beginning to go from stocks and bonds. So again, thank you so much for being here today, for letting me speak about the market. The most important thing is to stay healthy and stay safe, and also financially, protect yourself. Make sure you have a hedge against all this money printing and the financial risks that could be happening over the next few months. And you can always find me on goldstocktrades.com. You can find me on LinkedIn, Jeb Handwerger. You can also find me on Twitter at goldstocktrades, my username. And you can always private message me or email me at jeb@goldstocktrades.com. And again, I appreciate O&M to facilitate a discussion like this, digitally. This is the future, a way investors can connect, and I I'm so happy to be involved and to give an introduction before this next great gold company starts just telling us about what they've done so successfully over the past year. Thank you so much for having me.